Welcome back to All Things Money. My name is David Blain, and during today's show, we're continuing with our outlook for the markets and the economy for the year 2011. We hope wish you well for the year 2011 and that you had a healthy and prosperous 2010. I know that we did, and we are looking forward to 2011. Probably some challenges ahead in the investing world. We've been in the midst of a wonderful cyclical bull market. I hope you have been able to take advantage of it. We are possibly entering a season or a cyclicality of time where the markets could decline. We're probably looking at rising interest rates at some point, which is not the greatest scenario for bond investors. So it could be a challenging 2011, but we look forward to the challenges. There are investments out there that will do well in all sorts of different environments, and it's our goal to help you find those and help your funds grow. So before we move into the topics, let's give out phone number. We encourage you, let us know if you have comments, questions, topics you'd like to see on the show. The number is 252-633-0107. That's 633-0107. You can also email us at allthingsmoney@dlblain.com or visit us on the web at www.dlblain.com. That's dlblain.com. So before the break, we were talking a little bit about style allocation, meaning should you invest in growth companies, value companies, large, small. Those are what we call style allocations. I threw another one into the mix, what we call dividend payers versus non-payers, or high quality versus low quality. These are other ways to classify investments. And so we were currently mentioning that in a bull market, typically your smaller growth companies do well. As the market begins to peak, we would expect that the larger, more high quality companies would become a preferable place to invest. So what are we looking for? We're looking for, as I mentioned, the cyclical peak in the market. We're looking for the relative strength of small versus large, meaning that large companies begin to outperform small companies. These would be indications to move towards larger, more high quality companies, possibly dividend payers. Another thing that affects the stock market, long-term interest rates. If those start to go up, it affects the smaller companies much worse than the larger companies. The smaller companies' cost of capital, when they go to the markets, the bond markets to borrow money, they're much more sensitive to the interest rates rather than a large company. A large company like GE is able to negotiate or get better pay lower amounts of interest rate, where a smaller company looking for funding is going to have to pay a higher interest rate. So the high quality, low quality, typically we see technology, materials, energy, those tend to be lower quality, although, companies like Exxon at the higher end, Apple, those are definitely high quality, but as a whole, those sectors of energy, materials, technology tend to be lower quality. If we see those start out underperforming, the higher quality sectors typically are considered consumer staples, utilities, things like that. We would look for those to outperform. The same thing with growth and value. We're currently emphasizing growth. An earnings slowdown, an economic slowdown typically favors value companies, and value companies are cheaper companies based on earnings. They are companies that maybe don't have as high a growth prospects, and consequently, they don't lose as much in bad economic times. Dividend policy. There's a couple of things that we look at for dividend policy. Companies currently have a record amount of cash on their balance sheets, and so cash is available to invest in dividends or to pay out dividends. We like dividends at our firm. During explosive bull markets like we've been in, the dividends are of less importance. But as the market slows down or you have returns in the 4 or 5% range, then dividends become a very large percentage of that. Of course, The extension of the Bush tax cuts certainly helps dividend investors by keeping those dividend rates at the low rate of maximum of 15% or 0% in the lower tax brackets. So that's kind of the macro overview. In the style, we're emphasizing growth, small companies. As interest rates go up, we reach a cyclical peak in the market, and maybe the markets start to go down. We would encourage you to take a look at higher quality companies, larger companies, value companies, and companies that are paying dividends. Along with those themes, we're going to move into our sector outlook, the different sectors of the economy. You'll see that a lot of the themes that we've talked about already are going to play through these sector models. So currently, in the current market, we're emphasizing information technology, materials, and energy. Those are the sectors that are continuing to grow. The demand for those type of products and services is tremendous. In stage two, meaning that after the bull market peak, which we think will come sometime next year, we would emphasize things like utilities and consumer staples, your higher quality, dividend-paying type companies. Mostly larger companies, rising inflation. These companies also have a better ability to price their products, such as Coca-Cola. If inflation goes up, they have the ability to raise their prices much more easily, and people will still go out and buy Coca-Cola as opposed to some smaller company. Well, we're going to take another short break, and when we come back, we'll continue with our sector and industry outlook for the year 2010. For All Things Money, I'm David Blain.